Mridul, there is a view that the RBI should not be targeting headline inflation, it should target core inflation. And let me explain for the benefit of our viewers that headline inflation is what appears in newspaper headlines, which in the Indian context is the CPI based inflation, which is commonly called the headline inflation. So currently, RBI targets the CPI based inflation, which is headline inflation. But there's an alternative view that if you strip out the volatile components of the CPI, such as food prices and oil prices, which the RBI really does not have control over, then what is left is the core part of CPI, and RBI should focus on targeting the core inflation only. What is your view?
Rudra, I think uh, this in some way was answered by me earlier by sort of explaining to you that supply side shocks could be large and become generalized. So while these are more volatile components like oil and energy prices or food prices, sometimes people add gold to it. So those are the volatile prices and stuff. The point is very simple because if that relative price shocks can get generalized, it's better to look at the matrix which is encompassing the all commodities. CPI is what is the representative consumer in India faces as an inflation. And that should be the matrix rather than a segment thereof. Because if you are targeting core inflation, you are actually looking at prices which just have a weight of 47.3% in the CPI consumption basket. And CPI doesn't cover all consumption basket in itself. So we will really be looking at very segmented portion of inflation.
Right. So as I understand, what you are saying is that the headline inflation or overall CPI is ultimately what affects the common person. And therefore, the RBI cannot ignore that all encompassing basket based inflation. But isn't that contradictory to what Chief Economic Advisor Dr. Anant Nageshwaran had recently argued in a newspaper piece where he said that the RBI should focus on core and not headlines? So you are disagreeing with Anant Nageshwaran's view?
In a way, yes, but let's try to understand what the Chief Economic Advisor to the Government of India was saying. One, he said first in the economic survey that by targeting core, basically that's an improvement because otherwise, the way the inflation targeting is, you are trying to shift the terms of trade away from farmers, the agriculture part. Now, there may be only a tangential element to this because I don't think the terms of trade are entirely affected. If you can't have the argument that monetary policy cannot affect the food prices and then say that the terms of trade are getting affected because monetary policy is including food into its horizon. Now, the second part I want to point out is that practically no inflation targeting central bank in the world has actually targeted inflation based on the headline, the core inflation. The only exception was Bank of Thailand, which for a period of 2003 to 2000, I think 14, if I'm not wrong, targeted core inflation instead of headline. And then for a certain period, it also targeted forecasts of the core inflation as its target.
And how was that experience?
But that experience couldn't really work well, and they had to shift to headline as the matrix for inflation targeting. So the Japan, when it formulates, Bank of Japan formulates monetary policy, it sort of tends to look through some of the volatile prices, but its communication of the core of the target is the headline, not the core. So we would be pretty unique, and especially a country which has a large basket of inflation coming from food and energy. cannot really ignore those prices, is my limited point.
Okay. Now, regardless of whether we are targeting core or headline, which you prefer, why do we need to have a clear target?
Two very important things here. A clear communication of the target is the very basis of inflation targeting framework, which is based on transparency and credibility. So the central banks need to be clear as the formulator of the monetary policy on what it's doing, what is its ambition, what is its goal, what is the government asked it to do. So that matrix has to be unambiguous. Secondly, the credibility matters for the monetary policy, and therefore the public needs to be clear over what its target and what are the metrics it needs to see to keep inflation under control, because then only the inflation expectations will get impacted and we will come into a lower inflation regime. Now, having said that, I would sort of give a counterpoint also that this should not be taken to extremes, that the clear communication would mean that there should be no flexibility built into the inflation targeting framework. Inflation targeting framework needs some flexibility, because if you are an inflation nutter running monetary policy, then probably you will end up destroying a lot of economy without achieving the gains of the low inflation, which are actually the gains for a stable macroeconomy, which will come through. There have been ambiguities about what is the inflation target. Take, for instance, the US Fed. Now, the US Fed has an inflation targeting, and it is not very clear what that matrix of the target is, though we know that the preferred gauge for the Fed is the personal consumption expenditure inflation matrix and not the consumer price inflation matrix. There is a reason why Fed does that, because one, the PCE inflation is based on the Fisher's index, which actually obviates the difficulty which other price indices have, which are based on the Lespier's formula, where the weights become archaic as consumption pattern shifts. So they also have, the PCE has a wider coverage in terms of the items. It also covers rural economy, which is missed out in the CPI in US. The US CPI doesn't have rural component. It's based on the urban cities. So it makes sense for it to do that, but they also have this communication problem of lack of clarity of what the inflation targeting target should be. For India, the target is clear, and contrary to some misperception that the target is 2 to 6%, a careful read of the inflation targeting legal mandate as per the amended RBI Act is very clear that the target is 4%, and all you have is the tolerance bands of plus and minus 2%. It gives you some flexibility because supply side shocks can move the inflation out of the target. It also imposes some discipline that average inflation could probably be breached, even the tolerance bands could be breached for 3 consecutive quarters before it is described as a failure of inflation targeting. So it imposes discipline, it allows flexibility as well. In US, the same debate is being done in terms of should you look at average inflation, because otherwise, as you said, there is this risk that you may end up the economy into depression by targeting inflation too low.
Since you mentioned US, let me clarify that US officially has dual objective in its monetary policy, which is balancing both inflation as well as employment. So that's kind of the flexibility, I think, which we also have built in this inflation, flexible inflation targeting framework, where you mentioned the target is 4%, but there is a tolerance range of 2 to 6%.
Right.
So we had a very interesting conversation about monetary policy and inflation targeting, particularly with respect to India. But your closing thoughts, Mridul. where do you see monetary policy going in the years to come when there are so many new concerns coming up, such as should monetary policy try to target social change? Should it try to bring about a cleaner environment, reduce inequalities, reduce poverty? Should monetary policy respond to these kind of upcoming challenges like gender inequality, or should it stick to simple inflation targeting?
So these ancillary uh, angles to the monetary policy are something which is enriching the monetary policy framework, but they cannot substitute the major targets of the monetary policy, which is price stability, low inflation, and subject to inflation being under control, growth supportive policies could be put in place, especially because you need to have short-term counter-cyclical stabilization. So monetary policy, to my mind, would stay with this as a goal. It has stayed um, for years now. And uh, in essence, I think the current framework has served us very good. Uh, it has held us in good stead because once we introduce the inflation targeting framework, and I'll recall a bit about that because at the time when this debate was sparked within the central bank in 2013-14, 2014 more when we had a new governor in face of a taper tantrum, and the questions being asked was, uh, have we really lost the nominal anchor? And honestly, while markets were not seized of the issue because at that stage the inflation matrix was seen as a WPI inflation, which was averaging around 7% for the period 2008-9 to 13-14. This was the period where actually inflation sprung up because in the global financial crisis, we had given huge amount of monetary and fiscal stimuluses, which were not pulled back in time, and inflation resurged, and that kind of policy mistake had put this worry that your monetary policy system is not working. What we were seeing inside the central bank walls was four consumer price index, one on industrial workers, one on agriculture labor, one on rural labor, and the fourth one on urban non-manual employees, which has since been discontinued. All these four indices for 6 years period had an average inflation in double digits of 10%. Uh, so uh, this really made us worry that are we going to cause a huge financial instabilities, possibly a financial crisis, and then people will look back and blame what was the central bank economists doing at that stage. Nobody was noticing, but people were happy because WPI inflation was falling and had fallen from 9.3% to 5.7% or something like that by 13-14, and people were hoping that it's time monetary policy can be eased again. But to our mind, inflation was very high with 10% sort of matrix. We didn't have an all India inflation matrix. Monetary policy has to look at what is the inflation which the consumer faces, and WPI is not that inflation. It's closer to producer price index. So that was a big worry, and that was where Urjit Patel committee was formed, and we worked on that, and we realized that we need a new nominal anchor and inflation targeting provided us. We could introduce that in phases and formally through 2016, and it effectively disinflated the economy without any significant growth costs. So we could average uh, inflation below 4% actually, of 3.9% for the period since 2016 October when the inflation targeting framework was introduced till the point pandemic struck us. And that's where temporarily inflation targeting sort of created ripples because inflation came with growth falling due to supply side and demand side double whammy shock. But by and large, I think inflation targeting has worked well for India. And in the short run, in fact, over the medium run, I cannot say forever, because there's nothing like ever. I mean, today, there are around 30 countries in the world which have inflation targeting frameworks. Not everybody. You have 190 IMF members. So one size doesn't fit for all. It doesn't fit for all times also. But at the moment and in distant future of the vision I can have, inflation targeting to me looks like the best frame.
So final thoughts. CPI inflation has gone below 4% in February, which means would you say the RBI should now cut interest rates further?
So this is a very contemporary question. So let me put it in this perspective, that my assessment is that there could be two more rate cuts, but the scope for a lot of rate cuts doesn't exist. Because in the first place, we never raised policy rates very high. When inflation came back in a big way, after the recovery from the pandemic and then supply side disruptions of Ukraine added to it, you look at what other central banks have done. Inflation ran into double digits in UK and in Euro area, and very nearly double digits in the US. You look at what happened in Russia, 18%, Brazil, 12.2%. These were the peak inflation rates. And central banks have raised policy rates more than 10 percentage points, many of them. Even the advanced economy central banks have 525 basis point hikes, the Fed and others. Compared to that, we hardly raised. We had a 250 basis point, including the preceding slowdown period.
So what you're saying is monetary policy is not that tight, and therefore the cuts need not be that aggressive either. So I think the takeaway is that inflation targeting has served India well. The data bears it. Pre-inflation targeting versus post-inflation targeting, inflation rate has come down, and you expect this to continue for some more time. So on that note, thank you very much, Mridul. It was a pleasure talking to you. How did you feel about the podcast?
Oh, it's wonderful, and it's good you gave me this opportunity to explain my thoughts on an issue which is so dear to my heart. Thank you, Rudra.
Thank you, everyone. Stay tuned, stay engaged with policy debates such as this, and let us know on the comments if you want us to chat about more such issues.